Are there any risks associated with investing in opportunity zones? Opportunity zones promise tax-free benefits. But what risks are you taking on when you're investing in one? Everyone talks about the upside of opportunity zones, but what are the real risks? Everyone talks about the upside of opportunity zones, but what's the downside? We want to talk about what are the risks with opportunity zone investing. By the end of this video, you're going to understand the real risks of our opportunity zone investment and how to evaluate if the tax effects or benefits are worth the trade-offs. So what is an opportunity zone? Well, it's a federal program designed to revitalize distressed communities by encouraging real estate and business investment. Well, what are the benefits for investors? Well, here's a list. It allows investors to defer capital gains, reduce tax liability, and potentially pay zero tax on future appreciation if the property's held for 10 or more years. Sounds great, right? But there are strings attached. So risk one is that there's market risk for opportunity zone areas. Opportunity zones are federally designated areas where the properties that are acquired or built in these areas qualify for the opportunity zone status. These zones are typically in low income and economically depressed areas. What does it mean? Well, it means there could be slower lease up. There could be tenant credit risk. It could be lower exit liquidity because there's less available buyers who want to invest in these small markets. And there's uncertain appreciation because of the areas being potentially economically depressed. I've bought properties in opportunity zones and obviously not opportunity zones. And the key is to look at the area and the demographics regardless. I've seen opportunity zones that are in the heart of cities where the area is phenomenal, and other opportunity zones are in the middle of nowhere and you would not want to own property there. So do your due diligence on the area. Risk two is compliance and timing complexity. The OZ or opportunity zone rules are very strict. If your real estate partner or yourself are entering into one, be sure to comply with these rules. First is if you sell a property or have a large capital gains liability, you're going to need to invest that capital within 180 days of receiving those funds. You must hold the property or asset for at least 10 years to get the full exemption. Projects must meet the substantial improvement test. This is an important one I don't hear a lot of investors talk about. This substantial improvement test means within 30 months after you buy the property, you need to improve or reinvest double the value of the improvements on the asset. So what does that mean? Well, if you buy a $2 million property and 20% is allocated to land, that means there's $1.6 million of improvements existing on that property. To qualify for an opportunity zone, you'd have to make an additional $1.6 million of improvements within 30 months. So you're most likely rebuilding or heavily improving the existing asset with capital improvements like new roofs, tenant improvements, turning units, new parking, all of it. You have to invest that amount in order to qualify, or most opportunity zone projects are land development where you're going to be developing on the property and then meeting that criteria. Any mistake in this structure or in reporting would disqualify you from all the tax benefits that are available. Remember, this is not a set it and forget it investment. You need to highly focus on the details in order to meet the qualifications. Number three, liquidity and long hold periods. It's important to understand this risk by just being clear up front. In order to get the full tax benefit, you need to own the asset for a full 10 years. This means no liquidity, no refinancing, no sales, and no exit options during that period of time. The challenge is if the area does not improve, then the benefit of the opportunity zone is that you are not going to realize the appreciation of the asset. And then in turn, you're stuck in a frozen investment where your capital's just sitting there without the benefit. So remember, it's great for long-term patient investors, bad for investors that need short-term liquidity or need an early exit option. Risk number four is overpaying for the tax break. I've seen since the inception of opportunity zones in 2017, when the Jobs Act was passed, that now developers who own land in opportunity zones mark up the price of the land, factoring in the benefit up front. This essentially eliminates much of the upside for the opportunity zone investor because they're paying for premium pricing on land that otherwise would not sell. Investors get seduced with tax-free growth, but they don't do the underwriting because of the OZ status. Remember, a bad deal is still a bad deal, even if you get a tax break on it. We're underwriting for the fundamentals. Remember, cash flow first, location second, tenant demand, and then the operator or partner experience. Underwrite for these 4 key points before you get seduced into an opportunity zone investment. So the final thoughts are, should tax benefits incentivize your investing? Yes, I believe tax advantages do help influence investments, yet do not be seduced into an investment that otherwise wouldn't work. There's other options of 1031 exchanges, 721 exchanges, getting bonus depreciation and acquiring an asset in the same calendar year you sold an asset, using passive losses to offset capital gains. There's more than one way to skin a cat, so opportunity zones are not always the best option. So before entering an opportunity zone, let's look at these key things. You want to evaluate market fundamentals. The area is important. Remember, with real estate, the destiny is in the demographics. So if the area does not have strong jobs, schools, population growth, diversified industry, it's not a great area to invest in. So be careful in investing in those opportunity zone areas. Asset quality. You're going to have to buy an asset that has a lot of deferred maintenance, or there's going to be construction needed in order to meet the test of fulfilling the opportunity zone requirement. So be sure you're not buying a subpar or extremely damaged asset in order just to qualify for opportunity zones. Sponsor experience. Remember, the substantial improvement test. So in order to meet that test, that sponsor or that partner in real estate that you're working with or yourself are going to have to make those improvements within the 30 months. If the investment partner cannot do that, then the investment does not qualify. And there's always risk in real estate investments around budget and timeline when it comes to construction. So make sure they have a track record and a good book of vendors that they're going to be able to execute on this substantial improvement test and on the construction. And then lastly, the exit strategy. Will you be able to sell the asset if opportunity zones aren't available in the future? And are you investing just because it's an opportunity zone now? So overall, opportunity zones offer a huge opportunity for investors to defer capital gains and possibly not pay capital gains if you hold an asset for 10 full years. But this strategy is used to amplify an already good deal, not to justify one. So now that you know what opportunity zones are, let's take a look at depreciation and bonus depreciation in the next video. That way you understand there's more than one way to skin a cat. If you're looking to defer capital gains, there could be another way of accelerating depreciation through a cost segregation study and using those losses to offset that capital gain. Check out this next video.